Section 10, Lender Loan Processes. Unit 1, Qualifying the borrower. Unit 2, more on qualifying the borrower. Unit 3, Qualifying the collateral. Unit 4, Qualifying the title. Unit 5, Loan Closing. Unit 1, Qualifying the borrower. Lesson 1, Loan Approval Process. Lesson 2, Loan Application. Lesson 3, Review of the Uniform Residential Loan Application. Lesson 4, Loan Application Data Verification. Lesson 5, Review of Request for Verification of Deposit. Lesson 6, Review of Request for Verification of Employment. Loan Application Data Verification. Many large lenders have their own automated underwriting systems, many of which align with Fannie Mae and Freddie Mac underwriting guidelines. Regardless of whether the underwriting system is automated or not, the data provided as part of the loan application process must be verified. After verifying that all of these items are favorable, the loan continues through underwriting for potential approval. Bank deposits. The Federal Right to Privacy Act requires banks keep information about their customer accounts confidential. Prospective borrowers must sign a request for verification of deposit for each bank account they own so their banks can release account information to the lender. This allows the lender to verify current balance information. As an alternative, some lenders may accept bank statements for the 2 most recent months. Bank statements can reveal large deposits that might indicate gifted money, confirmation of cash reserves, and a consistent balance. Credit. Obtaining a prospective borrower's credit report will provide the lender with a history of the applicant's credit. The credit report lists accounts belonging to the borrower, including loan and credit card accounts, and whether those accounts are in good standing, whether there are outstanding balances, and what they are, and payment history. A repeated history of late payments can result in a loan denial. Lenders may ask applicants to explain information on the credit report. Employment. Lenders want to verify a prospective borrower's length of employment and wages earned, and may also seek to learn whether the employment is expected to continue. The borrower must sign a request for verification of employment, which allows their employers to release this information. As an alternative, some lenders may accept pay stubs for the most recent pay cycles. Income. Lenders may request tax returns in order to verify borrowers' income from all sources and the consistency of that income over several years. Loan application. A loan application is designed to provide information that a lender needs to determine a borrower's ability to repay a loan, and thus receive approval. The application gathers information about the loan being requested, the borrower's financial situation, and the property the borrower is seeking to purchase. Generally, a residential loan application collects the following information about the borrower: assets and liabilities, credit references, employment history, income sources. Assets and liabilities are commonly listed in a financial statement. This isn't obtained from a bank or credit agency. Instead, it's similar to a worksheet that allows the lender to quickly see borrowers' assets compared to their liabilities, which paints a picture of the borrower's net worth. Assets. These are items of value the borrower owns. Some examples include cash in hand, balances in checking or savings accounts, loan down payments, stock and bond investments, life insurance policies, real estate, whether encumbered or not, retirement savings, vested amounts, personal business assets, automobiles, personal property and other assets. Liabilities. These are obligations the borrower owes. Some examples include notes payable, installment accounts, credit cards, car loans, real estate loans, student loans. Section 8. Alimony/child support. Stock liabilities. Unpaid taxes, property, income. Other accounts payable or debt owed, insurance premiums, medical bills. Net worth. This is the difference between a borrower's assets and liabilities. Example. Ideally, a borrower's assets should be greater than his liabilities, resulting in a positive net worth. If his liabilities are greater, this would result in a negative net worth, which would make it unlikely that a new loan would be approved. Applications for commercial loans usually require more information in more detail, and cover greater periods of time. Some of the information that may be required includes rent schedules, tenant leases, financial statements, and credit reports. Loan approval process. Prospective borrowers complete loan application and submit to lender, along with additional documentation. Lender provides applicants with loan estimate within 3 business days of making the loan application. Lender assembles application packet and documentation for processing. Lender arranges appraisal of property. Underwriter evaluates application packet and property appraisal. Underwriter makes recommendation, yes, no, or maybe, related to the application. Approved applications head toward closing. Lender's closing department prepares documents for closing. Settlement agent receives loan documents. Settlement agent orders title search, survey, and insurance. The title search is generally done weeks or months before the closing, but a second search of the title record is done right before closing to ensure that no new encumbrances have been added to the record, which is especially important when seller is financially distressed. The lender prepares the closing disclosure and the settlement agent prepares the deed for closing. Borrowers receive closing disclosure at least 3 business days before closing. Borrowers attend closing, conducted by settlement, escrow, or closing agent, and, after funding and recording, get the keys to their new home.